Did you ever wonder how some people seem to effortlessly grow their wealth while others struggle to make ends meet? Well, it all boils down to one thing: investing. Investing isn't just about making money. It's about securing your financial future and unlocking the potential for exponential growth. And when it comes to investing, there's no place quite like the stock market. Picture this: a dynamic marketplace buzzing with excitement where fortunes are made and lost in the blink of an eye. Sounds thrilling, doesn't it? But beyond the adrenaline rush lies a world of opportunity and potential. So, are you ready to dive into the heart of the action and uncover the secrets of stock market investing? Join us as we explore the ins and outs of this captivating financial landscape and discover how you too can turn your financial dreams into reality. What is the stock market? At its core, the stock market serves as a bustling marketplace where shares of publicly traded companies are bought and sold. These shares, commonly referred to as stocks, represent ownership stakes in the companies themselves. For investors, owning stocks means having a tangible piece of a company's assets, profits, and future growth prospects. As an example, if I buy a share in Tesla, I own a small piece of that company and I become a shareholder. The stock market is a dynamic ecosystem where stock prices fluctuate continuously. These fluctuations are influenced by a myriad of factors, including supply and demand dynamics, company performance metrics, and broader market sentiment. Positive news about a company's earnings or growth prospects can drive stock prices higher, while negative developments may lead to declines. Additionally, external factors such as economic indicators, geopolitical events, and investor sentiment can also impact stock prices, contributing to the ever-changing landscape of the stock market. Why invest in stocks? Investing in stocks offers unparalleled potential for high returns compared to many other investment options over the long term. While individual stock prices can be volatile in the short term, historical data demonstrates that over extended periods, the stock market has consistently delivered substantial returns to investors. One of the key advantages of investing in stocks is the principle of diversification. By owning shares in multiple companies across various sectors and industries, investors can spread their risk and reduce the impact of any single company's poor performance on their overall portfolio. Diversification is a fundamental strategy for mitigating risk and increasing the likelihood of achieving long-term investment success. Moreover, the historical performance of the stock market underscores its potential as a wealth-building tool. Over many decades, despite occasional downturns and periods of volatility, the stock market has demonstrated a remarkable ability to outpace inflation and deliver real, inflation-adjusted returns to investors. This long-term growth potential makes stocks an attractive option for individuals seeking to preserve and grow their purchasing power over time. As an example, the S&P has, on average, returned 9.69% over the last 20 years, which shows the year-on-year growth you can achieve. Investing in stocks offers the potential for significant long-term returns, facilitates diversification to spread risk, and historically has outpaced inflation, making it a compelling choice for investors looking to build wealth and achieve their financial goals. Explaining compound interest. Let's look into the concept of compound interest through a hypothetical scenario. Meet Sarah, an investor who decides to regularly invest a fixed amount into a stock market index fund, such as £500 per month. An index fund tracks the performance of a specific index, such as the S&P. For the purposes of this example, let's say this fund typically yields an average annual return of 8%. In the first year, Sarah invests her money diligently, contributing a set amount each month. With an 8% return compounded annually, her initial investment grows steadily by the end of the year. As Sarah continues her disciplined approach into the second year, her investments from both years start to yield returns as the interest she earned in the first year yields interest in the second year, as well as the capital she invested earning interest. With the power of compounding, her investment grows even further, showcasing the potential of consistent investing over time. This pattern persists over subsequent years, with Sarah maintaining her monthly contributions and enjoying the benefits of compounding returns. Gradually, the growth of her investments becomes more pronounced, highlighting the significance of long-term commitment and patience. As we fast forward to the end of a decade, Sarah's dedication to investing has paid off. Despite starting with modest contributions, her portfolio has expanded significantly, demonstrating the remarkable effects of compound interest. Zooming out to a 20-year horizon, Sarah's commitment to consistent investing has propelled her towards financial success. What began as a series of small investments has blossomed into a substantial portfolio, underscoring the transformative potential of compound interest over extended periods. Using this example of a 20-year horizon, with Sarah investing £500 each month with a return of 8%. After 20 years, Sarah would have invested £120,000 in total over this period, and that investment would be worth just over £296,000. This hypothetical example serves to illustrate the profound impact of compound interest on wealth accumulation. By remaining steadfast in her investment strategy and allowing time to work its magic, Sarah has unlocked the key to long-term financial growth. How to actually invest in the stock market. There are a number of different avenues for investing in the stock market, such as brokerage accounts or share dealing accounts. These are accounts provided by brokerage firms that allow individuals to buy and sell stocks, bonds, mutual funds, and other investments. Brokerage accounts can be either self-directed or managed by a financial advisor. A popular one in the UK is Hargreaves Lansdown. Major banks such as Halifax also allow you to open a share dealing account. These accounts essentially allow you to invest directly in individual stocks or funds within the global stock market. Another avenue is through mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers such as Hargreaves Lansdown, Fidelity, Vanguard, just to name a few. The next option is exchange-traded funds, known as ETFs. ETFs are similar to mutual funds, but trade on stock exchanges like individual stocks. They typically track an index or sector and offer diversification at a lower cost. Next is stocks and shares, individual savings accounts. This is an investment account that allows you to invest into stocks and funds without having to pay tax. See our separate video on this topic. Lastly is beginner-friendly investment platforms. Vanguard, Fidelity, and Charles Schwab are popular brokerage firms known for their low fees, wide range of investment options, and user-friendly platforms. Robinhood and Trading212 are commission-free trading platform that caters to beginners with its intuitive mobile app and simplified investing experience. Key tips for researching stocks include analyzing company fundamentals, evaluate a company's financial health, earnings growth, revenue trends, competitive advantages, and management team. Assessing risk, consider factors such as volatility, industry trends, regulatory risks, and geopolitical events that could impact a stock's performance. Considering investment goals, align your investment choices with your financial objectives, risk tolerance, time horizon, and diversification needs. Utilize research tools provided by brokerage firms, financial websites, and independent research sources to gather information and make informed investment decisions. By following these steps and utilizing the resources available, beginners can embark on their stock market investing journey with confidence and clarity. Remember to start small, diversify your investments, and continuously educate yourself to navigate the complexities of the stock market effectively. In conclusion, investing in the stock market offers individuals a pathway to financial growth and security. Throughout this video, we've covered essential steps to get started in the stock market, including understanding different investment avenues and conducting research on stocks. Remember that building wealth is a journey that requires patience, discipline, and a long-term perspective. Thank you for watching. For more finance tips, don't forget to subscribe